If you were to die tomorrow, who would suffer financially? This is the planning question you use to decide whether or not you need life insurance. If the answer is no one, it's simple, you don't need life insurance. If the answer is someone, your spouse, children, parents, or business partners, then you do. When the answer changes from someone to no one, your need for life insurance just went away. So should the policy. So let's suppose that at this point in your life, the answer is still someone. You need life insurance. But what kind of life insurance? Agents are showing you all kinds of exotic, enticing plans that have all kinds of bells and whistles. Should you buy them? The title of this piece, Why Buy Term and Invest the Difference, clearly tells you where we at Snyder Advisors fall on this issue. Now, just to be clear, we are comparing permanent insurance, which is also known as a cash value policy, against term life insurance for the specific purpose of providing a death benefit. I'm not saying that it's never acceptable to purchase a cash value policy. Permanent insurance does make sense for a very small minority of people. A family with a special needs child, for example, will need to provide for that child's care for the rest of his or her life. And special needs trusts are typically set up with cash value life insurance policies in order to accomplish that. Wealthy people also will utilize cash value life insurance policies to pay their estate taxes. And business owners often need permanent policies for their succession plan. These people are using the product to accomplish a specific goal, which is likely different than yours. If you need life insurance, your goal is probably much simpler. It is to leave a check for your dependents in the event that you should die. The death benefit that your family needs can be accomplished with term insurance for a pretty darn good value. Let me give you an example. A 35-year-old healthy man who doesn't use tobacco is going to pay about $20 a month for $1 million of term coverage for 10 years. A permanent policy premium of the same amount is going to be like 20 times that much, literally. Term insurance is pure risk management. It pays for the cost of insurance during the specified period of coverage. And wasn't that your goal? Permanent or cash value insurance policies are meant to be a long-term vehicle that combines insurance with an investment account. A portion of your premium goes towards your insurance coverage, while the rest is directed to a separate savings account. Now, there are 3 types of permanent life insurance. There's whole life, universal life, and variable life. And the difference between each of those policies is essentially just how the separate savings account is invested. Whole life is going to be invested very conservatively in cash, money markets, and bonds. Universal life typically tracks an index, like the S&P 500. And variable life is invested directly in the stock market. And with variable life, if you're the policy owner, you can typically self-direct those investment choices. In other words, you get to choose which of the various funds you are going to invest that money in. All the benefits of permanent cash value life insurance need to be carefully looked at. In the first 3 years or so of a permanent policy, the cash value is eaten up by commissions and expenses. You need to be aware that an insurance agent will typically receive anywhere from 50 to 100% of your first year's premium. And what about return? James Hunt, who is an actuary for the Consumer Federation of America, has analyzed thousands of these policies, and he says that permanent policies, and I'm quoting, hardly ever yield a reasonable return unless held for 20 years or more. And what exactly is reasonable? be sure you're analyzing what we call the internal rate of return of the policy, which is the return net of fees and expenses. Most Americans can't get by with a 4% withdrawal rate. In fact, the majority are going to need a low double-digit yield from their portfolio to sustain 30 or more years of retirement. This is going to be nearly impossible to accomplish with a permanent life insurance product. Now, just as a note, we have a free special report on our website, SnyderAdvisors.com, called How to Not Just Survive But Thrive in Turbulent Financial Markets. There's another one called the 4% Withdrawal Fallacy. Both of those are going to be very, very useful in giving you more details on retirement and withdrawal rates, as well as required rate of return. And again, our website address is SnyderAdvisors.com, spelled SNIDERADVISORS. And where you're going to get these special reports is you want to look for free investor resources, and then in the drop-down you're looking for really good free stuff. And that's where you'll find those free special reports as well as many others. Okay, back to the topic at hand. The words professional management should scream high fees to you. What are these fees? Well, I can bet it'd be a surprise to the agent if he or she could find out, because those fees are almost never discussed because they're hidden and they're blurred in the product. On top of those fees and commissions paid to the agent, you're going to pay surrender charges to get out of the policy, and those charges will often apply for 10 years or more. Add inflation to the picture, and it's easy to see that the investment portion of these policies almost certainly do not match up well to your financial objectives. And moreover, the investment choices in these policies are usually lousy. In our opinion, you are much better off self-directing in an IRA. Cash value life insurance, those are all the negatives. Let me just tell you the positives, okay? Cash value life insurance does come with favorable tax treatment, often called a turbocharged Roth IRA by insurance agents. In theory it is. You pay the premium with after-tax dollars, and the earnings grow tax-deferred. However, the cash value is not always tax-free as many agents claim. If you surrender or cash in the policy and the total amount of cash value returned to you is less than the total amount of premiums paid, well then it's considered a return of principal and it's not taxable. But if the cash value returned to you is greater than the amount of premiums paid, the amount in excess of premiums paid is considered a gain and is taxable as income. If the policy you surrender is considered what they call a modified endowment contract, or a MEC, and the company will tell you if it is, then cashing in or borrowing against the cash value may be fully taxable. So you should definitely consult a tax advisor if that's the case. You can take out loans from your cash value tax-free, but agents often fail to mention that by doing this, you are greatly increasing the chances that your policy is going to lapse long before the nice illustration shows, meaning that the coverage that you think you have to a certain age will expire unless you pay a higher premium, which is often prohibitively expensive. If you don't pay the loan back, then that amount that you've borrowed is subtracted from your death benefit. And don't forget one other potential tax trap. If you've borrowed from the policy and then let it lapse, the investment earnings you've withdrawn become taxable. So if you aim to use the policy for income in retirement, you could end up facing a substantial tax bill late in life when the last thing you need is to be shelling out the big bucks to the IRS. Now, let's talk about risk. Just because the premiums are invested in short-term money instruments, and we're talking about a whole life policy here, that doesn't mean that there is no market risk. There is less risk than, let's say, a mutual fund. But there is, however, substantial interest rate risk. If interest rates are high, the cash value of the policy will grow accordingly. However, in a low interest rate environment, your cash value is going to be diminished as the insurance company's fees and insurance coverage, easy for me to say, costs are applied. If this happens for any prolonged period of time, you are going to run the risk of losing the bulk of your cash value, if not all of it. Another hidden aspect of cash value life insurance is that if you, the insured, die, the only death benefit your beneficiaries will receive is the face value of the policy. But what about all that cash value? Well, in most scenarios, the insurance company keeps the cash value to help pay out the death benefit, which wipes out all that hard-earned savings. Some policies do specify that beneficiaries will get both the face value and the cash value, but that comes with a price tag. And now for a word that insurance agents love: guarantees. Most insurance agents only highlight the non-guaranteed illustration, showing a return of 8.5% or so. They spend very little time showing the guaranteed illustration because it doesn't look so hot and would likely kill the sale. Put bluntly, insurance agents are salespeople. And while they are noble in their efforts to protect families in the event of premature death, most permanent life insurance recommendations are more beneficial for the agent in the form of generous commissions than they are for you. In our opinion, cash value life insurance is simply not the most efficient and effective way for you to manage the financial risk to your family of your premature death. The truth is, the policies almost never work the way they're explained in the sales pitch, and you're much better off following the old saw: buy term and invest the difference.